A key decision investors need to make is whether to use actively managed funds or passively managed funds. So what exactly do we mean by active funds and how do they differ from passive? Here's Crawford Spence, Professor of Accounting at King's College London.
Actively managed funds try to beat the market. They try to do better than average. The language in the field is generating alpha. That's what they use, the Greek letter alpha, to talk about generating better than average returns. So it's all about picking winners and losers in the stock market, and betting on the winners or the losers if you're going to short sell them. There's different ways to do that. It could be through conventional stock picking, fundamental analysis, sort of bottom-up stuff, or more quantitative investing, like more systematic, factor-based investing. But the ethos there is really to try and do better than average, so generating alpha.
So that's active fund management. And for many decades, active was by far the most popular way to invest. Let's take a look now at passive investing, which in recent years has been gaining ground on active and in many areas overtaking it.
Passive investing doesn't try to be better than average, it absolutely tries to be average. So instead of generating alpha, it does what they say tracks beta, is the language that you use in that space. So you'll take, say, a basket of stocks, maybe a weighted average of like the FTSE 100, for example, or the Standard & Poor's 500, and you'll just have a weighted portfolio in that index, and you'll just put your money in there and basically leave it. Track the index over time. Every 6 months or a year, your portfolio will rebalance. And the idea is really to generate returns, consistent returns over a long-term basis.
So, in a nutshell, those are the differences between active and passive. The all-important question is, which one's better? There is, in fact, a clear winner.
So the academic evidence has been pretty clear on which is better, active or passive investing. And this is nothing new. We've known for decades now that really over the longer term, passive investing delivers much better returns to investors. For example, any given year, you might find half of the active fund managers outperform the relevant benchmark, meaning that they beat the market. However, if you fast forward to maybe, a sort of 3, 5 or 10-year time horizons, the number of active fund managers who beat their benchmarks really dwindles quite rapidly, to the point where if you look at a 15-year time horizon, almost nobody beats the market in the active fund management space. And those people cannot really be identified ex ante. You don't know who they're going to be beforehand. And the other complicating factor is you don't know if they've beaten the market because of skill or because of luck. So, you're really talking about a very narrow number of people and very hard to identify, and you don't know why they've beaten the market either.
Despite the overwhelming evidence against using actively managed funds, there are still many financial advisors who recommend using them. So be sure when choosing a financial advisor that they're fully aware of the academic research that Professor Spence refers to.